To keep yourself updated, subscribe to IndigoLearn and click the bell icon and download our app OneFin to start learning on the go.
So friends, now let us look at the next question. Given the following information, that is exchange rate of Canadian dollar per DM is Deutschmark, it is the currency of Germany, spot, and Canadian dollar 0.670 per Deutschmark 3 months, that is basically forward. Interest rates of Deutschmark is 7%, Canadian dollar is 9% per annum. What operations would be carried out to take the possible arbitrage gains? Okay, so first let us write down the given data and then I'll explain to you a concept of how we should solve these kind of problems. Okay, so first, what kind of exchange rate is this? Per Deutschmark. So, if you are a Canadian citizen, then this is a direct quote, that is DM by CAD is equal to 0.665. Why? For 1 Deutschmark, how many Canadian dollars? Correct? Canadian dollar 0.665 per DM. Right, so 75 rupees per dollar. So we call it as USD INR. So same logic applies here. So this is spot, then DM by CAD 3 month forward is 0.670. So the Canadian dollar is depreciating. If it is depreciating, it means it has a higher interest rate. Is that correct? Yes, Canadian dollar has a 9% interest rate and the Deutschmark has a 7% interest rate. Now, how much is it depreciating by? Let me just find out. Okay, and this is a 3 month number. Okay, so depreciation of CAD is equal to 0.005. How did I get it? 0.670 minus 0.665. Okay, so this is depreciation of CAD is 0.005 divided by 0.665. So 0.005 by 0.665, you are getting a 0.0075. So this is a depreciation over 3 months. So if you need annual depreciation, you have to multiply by 4. So you will basically get 3%. .75% for 3 months. Correct? So it is depreciating by 3 percentage points per annum. Whereas, how much should it depreciate by? So, please don't say 9 minus 7 is 2. Okay, that is a very, very rough method. As students of finance, you cannot say that. Depreciation ideal as per interest rates. This is as per forward quote. Okay, as per interest rate is 1.09 divided by 1.07 minus 1. So, that is 1.09 by 1.07 is equal to minus 1. That is 1.869. So, I will take it as 1.87%. So, ideally it should depreciate by how much? 1.87. It is depreciating by 3%. Okay. So, now the question they have asked is, what operation should be carried out to take the possible arbitrage gains? So, there is obviously a possibility of arbitrage. Something, the interest rate ideally should be 1.87, but it is actually 3. So, there is definitely a possibility of arbitrage. Now, the key question in this kind of question is, how do you compute this arbitrage? How do you compute this arbitrage, or what do you borrow, what do you lend, where do you invest, all this, are typically the questions that you actually get confused. And if you remember our derivatives chapter, where we discussed, one very, very simple concept, that is, whatever is cheap buy, whatever is costly sell. If you remember that one single element or one particular logic, right, then everything else can be arrived at. I'll tell you how. Okay, before I tell you how, let me first explain to you what will happen if we take rupee example, and in rupees also I will take rounded numbers. Okay, here all these numbers are in percentage terms, 0.665 and all of that. I will take exact round number so that concept will be easily understandable to you. So, let us say USD INR, okay, is 100. This is spot. Okay, then there is forward. Let us say the forward is 110, and let me talk everything for 1 year. Okay, forward 1 year. Okay, I will keep it simple so that you understand the concept. Now, interest rate. INR is 21%, USD is 10%. Okay, so 100 into 1.21 divided by 1.1 is equal to 100 into 1.1, because 1.21 square root is 1.1. So, these two get cancelled, 1.1, that is 110. So, here this logic holds good. Now, for example, I say that this forward rate for 1 year is 110. okay, and this interest rate 21 and 10, instead of this 110, let me say this, instead of this being 110, let us say, and I'm taking purposely a very different number, I say this is 105. Let's say the forward rate is 105. Ideally, ideal should be 110, but it is 105. This is ideal forward. So, when you have a set of numbers like this, where ideal rate is 110 and forward is 105, what do you buy, what do you sell? Very, very simple. Remember the derivatives chapter. Whatever is cheap, you buy. Whatever is costly, you sell. So, this forward rate. So, you agree this forward rate is cheap, correct? This forward rate is 105 is cheap. So, you buy this. So, what do you mean you buy? You agree to buy dollars after 1 year at 105. Okay, you are buying it at 105, but arbitrage means what? You buy and sell across different time periods or across different markets so that you make a riskless profit. So, if this is the buy leg, then there has to be a sell leg, correct? If this is the buy leg, you are agreeing to buy forward of dollars at a future date at 105. So, this is the buy leg. What is the sell leg? I will tell you how to arrive at the sell leg, but work backwards, okay, work backwards. See, on that day, which day? After 1 year. After 1 year on the maturity date, you are planning to buy something, dollars, correct? If you are planning to buy dollars on that rate, you will give rupees and take dollars, correct? If you have to give rupees, you need money in rupees on that day, correct? If you need money in rupees on that day, it means that you should have invested money in rupees on some day at the beginning of the year. If you have to invest money in rupees on initial date, you have to either borrow money or you borrow in dollars and convert it into rupees. You borrow in dollars, convert it into rupees, correct? And invest those rupees till this particular 1 year period. So, when you have to borrow dollars, initially at the beginning of the period, you have to borrow dollars, right? When you are borrowing dollars at that point of time, you are agreeing to buy dollars at a certain rate. That is, at spot, you borrow dollars and convert them into rupees 100. So, you purchased currency at spot on day 0. Okay, so I'll work backwards again. I'll repeat the steps. So, you've understood this concept. This is cheap. This is costly. So, whatever is cheap, you buy. Whatever is costly, you sell. Okay, so you start with cheap. Cheap is buy. So, now you agree to buy the forward. Enter into a contract to buy US dollars at 105 rupees after 1 year. So, let me start from last step. I will not write the number, but this is the last step. Okay, so you buy dollar at 105. This is a pre-decided contract. So, you are entering into step 1, forward contract to buy dollar at 105, and you are executing that on the last day, correct? Because I said whatever is cheap has to be purchased. So, you are agreeing to buy dollars. If you are agreeing to buy dollars, what does it mean? You will give in exchange rupees, right? Buy dollars and give rupees. So, you buy dollars and give rupees. Then, what is the previous step? If you have to give rupees, you have to have rupees. Okay, have rupees with interest. Okay, why with interest? Because when you are trying to do this, arbitrage process, you borrow from one currency, invest it in one rate, then change it into another currency, invest it in another rate. So, I am explaining you the logic with respect to that. So, have rupees with interest. So, if you have to have rupees, then you have to invest rupees. Invest rupees. If you have to invest rupees, let's say you don't have rupees, then if you don't have rupees, then you have to borrow. So, you have to either borrow in rupees and then invest in rupees. Both of them, borrowing rate and investing rate, both of them will be same. So, obviously, there is no logic that you borrow in rupees and then again invest in rupees. No. So, you'll have to borrow in dollars and convert to dollars. Next step is convert dollars to rupees. Okay. If you are converting dollars to rupees, it means borrow in dollars. So, the previous step for that is you have to borrow in dollars. Okay. So, step 1, 2, 3, 4, 5, 6. So, whatever is cheap, what is cheap? The forward contract is cheap. So, you have to buy that particular forward contract and you execute that particular, or rather deliver or meet the commitment as per the forward contract. And then there is one more step here towards the end. because you have borrowed in dollars, you repay dollars. And because you have purchased in dollars in step 6, right? The dollars you repay the dollars, balance is profit. Step 8 is profit. See, okay. So, now this is one logical, very logical way to actually understand how, if there is an arbitrage opportunity, how to figure out that particular opportunity. Okay. So, now if it is other way around, that is, if it is not 105 but it is 115. So, let us take the same example, US spot forward 100 115, interest rate INR is 21%, USD is 10%, right. So, ideal rate should be 100 into 1.21 divided by 1.1, which should be 110, whereas it is 115. So, if this is 115, then you have to sell forward. So, step 1, sell forward dollar at rupees 115 per INR. So, I will get INR, okay, I will get INR. In the previous case, buy dollars at 115, that is, you will give rupees and take dollars. Here you are selling, you have sold forward, right. So, you have sold a dollar and you are getting INR. It is exactly opposite. So, this is step 1. So, let us come to the bottom step. What is bottom step? So, you are selling forward, entering the forward contract to sell dollar at 115. So, deliver dollar, get rupees. Okay. Next step is repay loan in rupees. After that, next step is profit. Okay. And what happens here? You work backwards with the step. You deliver dollar and get rupees. If you have to deliver dollar, you need dollar money, right. Previous step is have dollar money with interest. Okay, meaning invest dollars, meaning borrow in rupees. Okay, you borrow in rupees, you invest in dollars, you have the money, have dollar money with interest, you deliver the dollar and get the rupees, you repay the loan in rupees and you will be left with a profit. Okay, so this I actually left more gap here. This is step 1, this is step 2, step 3, 4, and then we have step 5. I have compressed the steps slightly, convert into rupees and all of that. So, if you want, you can add that step also. You can call this as borrow in rupees, convert to dollar in spot. Okay, then this will be step 1, 2, 3, 4, 5, this will be 6, this will be 7, 8. Okay, sorry, you will have the exactly opposite sequence of steps depending on which way the rate is. If the forward rate is higher for USD INR and it is not matching with the exact theoretical price, then this is the set of actions you do. If it is, if it is lesser, then this is the set of actions you do. So, you have to work backwards to understand. So, don't get confused on this. Some of you may try to remember with, single line stuff like, if forward premia is high, then you have to borrow in dollars and pay in rupees and all of that. I would typically tend to get confused if I remember things like that. If I remember things like that, I will definitely get confused, which is why I always choose a method which is more logical, where I can know the exact flow. With this, now you know the full flow, right? So, you need not actually again think of what is to be done and all that. You know the entire flow. So, you work backwards with this. Okay. So, now given this, let us solve this particular problem using this kind of philosophy or this kind of logic. Okay. So, friends, now let us see how do you do this as per whatever steps we discussed. Okay. So, it is DM by CAD spot 3-month forward 0.665, 0.670, interest rate dash mark 7% per annum, Canadian dollar 9% per annum. Okay, correct, right? Then we also figured out annualized rate is 1.87. So, ideal DM by CAD forward 3 months is equal to 0.665 into we got the rate as 1.87%. So, 1 plus 1.87% by 4, right, because it is 3 months, right. So, 1.87 divided by 100, okay, divide by 4 plus 1, okay, into 0.665, that is 0.6681, okay. So, ideally the exchange rate number of Canadian dollars per Deutschmark should be 0.6681, but there are 0.670. So, what is cheap, what is costly? This is cheap, this is costly. So, what do? You sell costly. So, you are supposed to sell the costly thing, that is you are supposed to sell a 3-month forward. So, when you sell this, what do you get? So, here when you take Deutschmark per CAD, you are selling this because you are getting more of something. What are you getting more of? So, you are selling a Deutschmark and getting more CAD. So, basically last step is sell Deutschmark and get CAD, okay, as per forward. So, first step is enter into forward to sell CAD at 0.670 and buy Deutschmark, okay. So, this is forward. Okay, now work backwards. You are selling Deutschmark and getting CAD means you have DM, right? If you have DM, you have DM plus interest. So, that is you have invested DM. If you have invested DM, it means you have borrowed in CAD, okay. Then you have converted to DM. If you have borrowed in CAD, and you have converted to DM, right, this is not DM, this is DM. Borrowed in CAD and converted to DM. So, this conversion, right, is at which rate? Conversion is at spot. Then you sell the DM and get CAD, then repay CAD loan, then you get profit. Okay, these are all the steps. Okay, so I will probably, I think I have written it slightly below. So, I will write the first step also below only. Okay, enter into forward to sell CAD at 0.670, 3-month forward. Okay, so I can delete this. Okay, these are the steps that you are supposed to do. So, you borrow in CAD. You borrow in CAD how much? Have they made any mention of the amount that you are supposed to use? What operations? Nothing. So, we can take a round number. So, borrow in CAD, you take $1,000. Borrow CAD 1000. Convert in at spot into DM. How much? 1000 CAD you converted spots. For every 0.665 Canadian dollar, it is 1 DM. So, how many DM will you get with this? If you convert this into spot, you will get 1503.76. Okay, you will get so many DM. Now, invest this DM at this borrowing is at what rate? Canadian dollar interest rate is how much? 9%. At 9%. Okay, then invest in DM. So, at 7%. Correct? Yeah, 7%. Invest at 7%. So, 1503.76 is invested at 7%. So, 1503.76 and this for how many months? 3 months. So, into how much is the interest rate? Interest rate is 7%. 7 by 4. 7 by 4 is 1.75%. So, 0.0175 plus 1 into 1503.76. Right. You get 1530.0758. Okay. Then you sell this DM and get CAD. So, 1530.0758 into 0.670, right, because you have to get CAD. So, into 0.670 because that is what you enter into forward at. So, you will get 1025.15. This is the money that you will get in CAD terms. But here you borrowed CAD at 9% per annum. So 9 divided by 4 is 2.25, divided by 100 plus 1 is 1.0225 into 1000. You will get 1.1022.5. Okay. So you have borrowed and you have to repay 1022. So repay CAD loan of 1022.5. So your net profit is 1022.5 minus 1025.15. You will get 2.65. Both are in Canadian dollars. So CAD 2.65. Okay, CAD 2.65. Now this can obviously be written much neater when I am trying to explain to you in over the course of doing the discussion. This is how I have written. But if you were to put it in a format, if you were to draw a box and put it in a format, it will appear much neater. Because of the space constraints, I have written it like this. Ideally, when you are writing in the exam, please draw a proper table. Start from the bottom, and as you move up, please put a single line, and please have a column here on the right hand side, so the data will be very clearly visible. Okay, so you will make how much? 2.65 Canadian dollars at the end of 3 months. Now this, if you want to convert into Deutschmark on that rate, on that day, you can, they have not specified whether it is in Deutschmark or CAD, okay. If at all they say, you have to convert into Deutschmark, you can say that I will enter into a transaction at that particular point of time, at initiation time itself, to figure out, I will enter into a contract at 0.670. So I will get so many number of Deutschmark at that particular point of time. So basically, even the profit can also be taken at the original forward rate instead of the whatever is the rate that we arrived at. We arrived at one rate, right? 0.668 or something. 0.668. So you can say instead of 0.668, even for the profit, we can actually enter into a forward contract at the beginning of the contract, so that you actually can lock in the value of the Deutschmark that you will get. Okay. Fair enough. So this concludes this particular question. Only request that I have is, when I am trying to solve, I couldn't put it in a column. You please put it in a column in a neat tabular format with 2 columns. So it will actually be much easier for me. Because of the space constraints, I couldn't actually do that, because I was trying to parallelly explain to you as well as trying to solve the problem. Fair enough. Okay. Now let us move to the next one.